Hello everyone, I hope you're doing well. Today I am going to present my project on credit risk. In this project, we will explore the entire loan granting process a bit and understand how we can assess the risks associated with a lender. The goal of this presentation is to understand how financial institutions evaluate and manage credit risks by using machine learning techniques and data analysis. So we'll start with a little story to make the explanation much clearer for everyone. And in this story, we'll take the example of a young man who has just finished his studies. He lands his first real job, a well-paid permanent contract, and he wants to buy a car to get to his workplace. So he goes to his usual bank, paperwork in hand, feeling confident, and he asks for a car loan of, let's say, 15,000 euros. But a few days later, he receives a letter. "We regret to inform you." Well, I think you know that famous message that starts like this. In short, it's a rejection. And now we might wonder, the question is, why was he refused? After all, he has a permanent contract and the amount he's asking for isn't really beyond his means. We could ask ourselves a lot of questions, but for our example, let's just say it's because the young man has never had a loan before. So no history, and without history, well, there's no proof that he can pay it back. Yes, it's actually the famous vicious circle. You can't get credit without a credit history, but you can't build a credit history without credit. Fortunately for him, there's an alternative. The young man can turn to a non-banking financial company, also known as an NBFC. In fact, NBFC is an Anglo-Saxon term for non-banking financial company. So these NBFCs are financial institutions that aren't really banks. They don't have a banking license, let's say, but they still provide financial services. And these institutions have different evaluation criteria, and they can approve loans that traditional banks would refuse. To give an example of a non-banking financial company here in France, we can mention Cofidis, which can provide loans, consumer loans, or any type of loan, without the client needing to go to a physical bank. And so the main question of this presentation is, how do NBFCs make their decisions? In fact, the entire project that this presentation is dedicated to will revolve around this question. Alright, now let's move on to the different steps involved in granting a loan. So when someone wants to obtain a loan, the process always starts with an official application. This can be an online application, or the borrower can go directly to the branch. And they provide a set of documents such as identification, proof of address, pay slips, bank statements, and many other documents. Next, the financial institution carries out what are called preliminary checks, and these initial verifications ensure that the person is indeed real, that the documents are authentic, and that there is no fraud involved. For example, it can happen that individuals use fake identities to obtain credit and then disappear with the money. Next comes the credit assessment. At this stage, the company consults a credit bureau to obtain the person's debt history. It's a bit like a financial report card where you can find previous loans taken out, payment delays, and many other indicators of credibility or reliability, let's say. And so this information feeds into a scoring model. Here, we start gradually introducing the key terms of this project. So this scoring model assigns a risk score to each application. In some cases, a field investigation is carried out. An agent goes directly to the applicant's home to confirm the address and make sure the information provided is accurate. Now, if the loan is secured by an asset, for example, a house, land, or a vehicle, an assessment of the collateral is carried out. This makes it possible to determine whether, in the event of default, the value of the asset is sufficient to cover the amount of the loan. Finally, the file is presented to a credit committee, and this committee reviews all the information, that is, the personal data, the risk score, the collateral value, and can decide to approve the application, reject it, or approve it with specific conditions. For example, a borrower considered more financially risky. Let's take the example of a freelancer who changes clients every month and typically doesn't have a fixed regular income. Over several months, they may be offered a higher interest rate. So if everything is approved, the loan is granted and the funds are transferred to the client's bank account. Now, to build a model capable of predicting whether a loan will be repaid or not, we need precise data. These are the client's personal data, the data provided by the credit bureau, and finally the data related to the requested loan. So personal data can help to understand a client's stability and reliability. If we want to talk about age, a young professional just starting out in their career won't have the same risk profile as someone who has been in a stable job for 20 years. And professional situation is also important. Having a permanent contract in a solid company inspires more confidence than a precarious or seasonal job. Seniority in a position is also an indicator of stability. If a client changes jobs often, that can be concerning. Of course, the lender's income is also a major factor. The higher and more stable it is, the easier it is to repay a loan. Sometimes the applicant's postal code can also be considered when applying for a loan. Because certain geographic areas have historically had more payment defaults, and so they can influence decisions. And finally, the type of residence and how long someone has lived at their current address are also indicators of stability. For example, someone who has lived in the same home for 10 years will be seen as more stable than someone who moves every 6 months. That's more or less what a typical credit score looks like. You may have already seen one, but if not, you can just search on Google and you'll find some. So in the image here, we see a score of 716. If we want to apply it to our earlier example with the young professional, let's imagine he has a score of 716. That would put him in the good category. And that's already pretty good for a young person just starting out. But in our project, we're not going to use this ready-made score. We're going to build our own because every financing company has its own view of risk. Some are more tolerant of young people, others prefer senior profiles or entrepreneurs, and many other cases. Office data. So here there is a missing word. We want to talk about credit bureaus. So first of all, we're going to define what a credit bureau is. A credit bureau is an organization that collects and centralizes history from a particular point of view. It provides information on the number of open accounts, the number of closed accounts, or even the number of applications. So when we talk about open accounts here, we're referring to ongoing loans or credits. We're not talking about your checking account or your Livret A account. We're talking about credits such as car loans, consumer loans, loans for renovations, I don't know, all sorts of other credits. And the number of closed accounts, that's actually a good sign for a borrower. It means that the client has already borrowed in the past and has finished repaying their loan. As for the number of applications, if a client applies for several loans in a short period of time, it can indicate a rather strained financial situation. So, a high number could be misinterpreted by lending institutions. Credit bureau data. So, we're still talking about credit bureau data, but here we're going to consider this data as leading indicators of the credit bureau. To explain what the credit utilization rate is, it is the proportion of available credit that is already used. For example, if a customer's total credit limit is 10,000 euros, and if the client uses 8,000 euros, then the utilization rate will be 8,000 divided by 10,000 times 100. And so we have a rate of 80%. Next, months of missed payments are periods when payments were made late, meaning how many times this individual has been late on their payments and the number of months since the most recent late payment. The higher this number, the more reassuring the client and their financial profile are considered to be. To give an example, it's as if the client takes out a loan and makes payments every month. Let's imagine he was 2 days late, for example, in the month of January, and so we start counting from that month. We check if he is punctual in the following months. So these are the months we count, and this represents the month since the last late payment. And finally, the days of delay are simply the difference between the scheduled payment date and the actual payment date. A client who always pays with a 10-day delay presents a higher risk than a punctual client. Finally, there is the loan data, or more specifically, the data related to the requested loan. And for this data, we have the loan amount, the purpose of the loan, and the loan to income ratio. And that's it. Speaking of the loan amount, the higher it is, the greater the risk. Well, that's pretty logical after all. And the purpose of the loan is the reason for applying for the loan. A loan to buy a productive asset like a tractor for a farmer can be seen differently from a client who applies for a loan to finance their vacation. Regarding the loan to income ratio is the portion that the repayment represents compared to the income. For example, if someone earns 2,000 euros per month and applies for a loan with monthly payments of 1,500 euros, the ratio is too high and the loan will probably be refused. Finally, there are additional fees when you apply for a loan. These fees include application fees, possibly insurance, and taxes. You can apply for a loan of 5,000 euros, and when the funds are disbursed, you receive 4,500, but in the end, you still have to repay the full 5,000 euros. The 500 euros are for application fees, insurance, and taxes. That brings us to the end of this presentation. And during this presentation, we went through all the steps involved in granting a loan and the data needed to assess risk. This business understanding will help us build a scoring model that can be used in real-life situations. And I'll just leave you in the section. Project portfolio description, the Streamlit link, so you can interact with the model in real time. And on my GitHub, I'll post all the lines of code. Thank you for your attention and see you very soon.